Stock Play of the Day Overtime is an educational program. Any statements made by Ally Invest employees are not intended to be or should be considered investment advice, a recommendation to buy, sell, or hold a security, or a recommendation to adopt an investment strategy.
Hello and welcome to the Stock Play of the Day Overtime. On Tuesday's Stock Play of the Day, we looked at Target. Today we'll discuss, did we score or did we fumble? Hello, my name is Brian Overby. I'm the Senior Options Analyst at Ally Invest. All right. On Tuesday's Stock Play of the Day, we looked at a long call spread in Target. That was our paper trade for the week. I'm currently highlighting the long call spread inside the options playbook. And the goal of this trade, when we were looking at it, was to speculate on a good earnings report from Target without having a ton of risk in that position. We tried to manage the increase in implied volatility that usually happens around an earnings report. And we had a lot of news that was going on also. There's just been a lot of news in the market, more than normal. There usually is a lot of news, but in the last couple of months, we've had a lot of headlines to deal with in the earnings report, geopolitical concerns, inflation, the Fed, you name it. So we looked at a long call spread, and the concept of the long call spread was we were going to manage how much time premium we were buying relative to the time premium we were selling. We were trying to get a 50-50 ratio on our trade. So in the playbook, the way the scenario would play out is that the stock would be somewhere close to where we're crossing the x-axis, somewhere between strike A and strike B. Our goal was to buy approximately the same amount of time premium on the option that we bought that was in the money as the option that we sold that was out of the money. And when you do that, if you buy similar time premium on your long call spreads that you're selling, you will usually end up with a 50-50 ratio. And the only way that you can do that is you need to straddle the marketplace. Now, we knew that the expected move was about 6%, around 13 points. So the underlying stock could easily move above our strike B or make that expected move to the downside. And it definitely did to the downside. So let's look at what happened with Target. And it's going to be a short and sweet overtime edition today because the market went hard against the position. So here's Target. This is a 15-minute chart, 5 days. We always tape live at noon on Tuesday. So here's the 17th. This was the rest of the day. Target didn't do too much going into the end of the day. And then we had a big downturn, almost double the expected move to the downside. And then, this was Walmart's earnings. So let me go back. Let me jump back just for a moment. And then I'll explain a couple of the rationale that was behind the paper trade or the speculative trade this week was that here's where Target was trading. And then Walmart announced earnings the day before we had the downturn. Stock traded pretty down, but from the point that it had the big downturn, it traded flat pretty much all day long. We were going into earnings. We're like, okay, let's look for a little bounce in the underlying stock. And Target announced earnings, and they were almost on the same pace as far as the news of Walmart. And then we were way down for the rest of the week. There was really no opportunity to get out of the trade to try to salvage anything. We kind of knew that going into the trade, that it was either we were going to risk 250 to make 250, or we were going to lose that 250. And that's just the way speculating around earnings is. And if we look at the Walmart chart, things are really ugly in the Walmart chart. This was the day, remember 15-minute chart. So this was the day they announced earnings. This was their trading all day long, drifted lower. And then Target announced earnings, and then it really drifted lower. So Walmart really took the brunt of everything. Target looks bad, Walmart looks worse. And as far as the stock play of the day is concerned, it was, I guess, in hindsight, you got to be happy that We did a hedge in that we did a long call spread. We bought an option contract and sold one so that we lowered our overall cost. We didn't just go out and buy an option outright. We sold something to try to reduce the cost overall. So if I look at the chart today, it's going to be short and sweet because there's really nothing left. Our trade our paper trade for the week was we were buying the 212.50 strike, selling the 217.50 strike. We went out a little bit further. We went out 7 days. So we basically got a chip in a chair, if you will, in that the market could come back. It's very low probability that it's going to make that move all the way back, but you're still in the trade. What would I do with this trade? Well, basically, there's nothing you can do. We've driven the car off the cliff. There's no reason to take it to the repair shop anymore. The trade is done. It's over with. When we were putting the trade on, if I go all the way back to the 15-minute chart on target, one of the concepts that we were looking at, and it just was it had nothing to do with the charts or fundamentals overall, but if you've ever heard the term that's been used for many, many years in the marketplace, we're looking for a dead cat bounce. And if you need to Google that, that's fine, but it's a little bit morbid. But the concept is that if you drop a cat off the roof, even when it hits the ground, it's going to bounce a little bit. And that's what we were kind of hoping for in Target, that the bad news was out about Walmart, supply chains concerns, everything. It drove Target down. And we're hoping that Target could have had a little bit better news going into earnings and basically just get back to where it was. That's what the whole goal was. Did not happen. Stock got cremated. No opportunity to close out the trade. So ideally, you're going to ride this for another week. Hopefully, you got to play the hope game. The market would come back and make something feasible. Maybe you put in order to sell to close that trade for $1, just leave it in there good until canceled. If it did make its way back, you'd hate to miss out that opportunity to try to get a little bit of your investment back on the trade. But if not, when we run to the Ally Invest option chains here, you see that it's trading basically at zero. There's no time premium in either of these option contracts. So very simple, very straightforward. As always, whenever we're looking at these trades, nothing's ever meant to be a recommendation. We just address the market conditions and try to apply a strategy that would fit what's going on in the marketplace. So please click subscribe, ring the bell, and hopefully we'll see you this Tuesday for the next stock play of the day. Thanks for coming, everyone.